Welcome to FinScale, a podcast created by Solen Niederkorn, shedding light on innovation in finance, banking, and insurance.
Navigating the complexities of managing a publicly listed VC fund. Timm Levene, CEO of Augmentum FinTech.
So we have a really differentiated set of investors relative to the usual VCs. And for me, a big ambition was to really democratize that access to venture capital. And I think we've done that to a certain extent. We've got a long way to go, and hopefully we'll be the first of many others operating under this structure.
I am thrilled to have Timm joining us today. He shares with us the unique challenges and opportunities that come with managing a publicly listed fintech fund. He explains that the decision to list Augmentum was made to provide liquidity for shareholders and align their interests with those of entrepreneurs and investors. We explore the delicate balance between shareholders' expectation and long-term investment goals and how Augmentum manage investor relations and fund structure. Timm also explains Augmentum's investment thesis and their focus on deals within the fintech sector, particularly in digital banking, wealth management, and insurance. We take a closer look at Tide. Timm explains why they chose to invest in this particular fintech and how it positions itself in the European ecosystem. Overall, this episode is a must-listen for anyone interested in Augmentum and the world of fintech and VC funds. Enjoy the show! Hello, everyone. Hi, Timm. Very happy to have you on my podcast. And I would like to say a big thank you to Reginald for his kind intro. May I ask you to quickly introduce yourself?
Absolutely. I'd be delighted. My name is Timm Levene. I'm the CEO and founder of Augmentum FinTech. Augmentum FinTech is a publicly listed fintech fund listed on the London main market, focused on private fintech assets. And the unusual part about us is we are a venture capital fund, but investors, both retail and institutional, can trade us on a daily basis.
Excellent. And prior to be in the VC space, where were you?
So I would describe myself as an accidental VC. I've been an entrepreneur, and I still would like to classify myself as part entrepreneur, part investor. I think doing something different in the VC world has been a kind of a challenge of the past decade. Back in the late 90s, I did something quite unusual, and I left a very stable job in the strategy consulting world, a business called Levene Company, and decided to open the first juice and smoothie bar in London, based in the city, as the advent of kind of healthy eating started to really move forward. And so that was my first foray into the world of kind of entrepreneurship, and I learned the hard way how hard it is to run 1-2 shops. That business evolved to be a 31-store business called Crush, which still exists today, despite having some pretty challenging moments during the last couple of years of COVID. And then in 1999, I was part of a team that launched an internet business called Flutter.com, which was based here in the UK, became a global business, merged with a company called Betfair in 2001, and became one of the highest profile internet betting businesses globally. And actually, when we built that business, it was all about disrupting and disintermediating traditional betting companies through technology. So back in 99, certainly in the UK, where we have a very strong regulated betting industry, it was controlled by three players who had pretty much about 85-90% market share. And I think that really opened my eyes when you see an oligopoly that is held together by regulation. As new technologies evolve, and they often move quicker than regulation, it was a great lesson in how innovators can really disrupt a very slow-moving and traditional industry. And within 5 years, Betfair was bigger than all three of the incumbents, and in probably 5 years later, was bigger than all three of them put together. So it's a great lesson and example of true disruption, and was a fantastic journey to be part of.
Thank you. What a career.
Well, it's still going. Hopefully there's a few more stories to be written.
Excellent. Okay, so you said in the beginning that Augmentum was listed. Before we start decipher what you do at Augmentum, I would be interested to know more about the reason why you decided to get Augmentum listed.
Yes, it's a really good question, because venture funds almost always are structured as what's known as GPLP structures with 10-year fixed lifespans, with the opportunity, obviously, to extend that life. But I think for me, my first phase in venture back in 2010 was really, can I adapt from operator, entrepreneur to investor? We had a more traditional GPLP fund backed by a single LP in a large listed investment trust here in the UK, really led by the Rothschild family. But I think what was quite clear in about 2016-17, as we were getting to the end of our investment cycle, was that the market was becoming increasingly more competitive, increasingly noisier. There were more what I would regard as entrepreneur-led VCs, where there was a real dearth of that when we started in 2010. And I think the challenge was, how can we differentiate in the market? And I think for us, we were able to differentiate firstly through our focus. So we had a pure focus on FinTech, which was helpful. Two, the background of the senior team was more entrepreneur and operator led, which I think current founders and entrepreneurs truly do warm to, and our experience does resonate. But three, the opportunity to have a differentiated structure where we could have permanent capital, where we weren't being pressurized by a finite time frame, just felt to me an opportunity to say to founders, we are not going to be forced into an exit because, hey, in 3 to 4 years, we're going to invest this fund and then go to our next fund and we want an exit so we can prove out that we have DPI. Fundamentally, our ambition is to be aligned with our founders, but also to exit at the right time. And that might be 2 years, it might be 10 years, it might be 15 years. So it just gives you added flexibility in terms of that patient capital, and also allows us to open up the market to a far broader audience. So we have a large number of retail investors who have always wanted to get exposure to diversified venture capital, in particular FinTech, and we give them that direct exposure. And I would say of our shareholder base directly, i.e. individual shareholders holding in their name, that's about 15% of our shareholder base. But if you look at the discretionary wealth managers who hold on behalf of their clients, they probably make up another 50%. So we have a really differentiated set of investors relative to the usual VCs. And for me, a big ambition was to really democratize that access to venture capital. And I think we've done that to a certain extent. We've got a long way to go, and hopefully we'll be the first of many others, operating under this structure.
I was about to ask you the question, why not choosing an evergreen fund? But the biggest difference is also the access, because evergreen funds are not accessible to retail investors. Exactly.
And I think in a market that we've seen in 2019, 20 and 21 in particular, a lot of money flooded into the sector. Venture capital was booming. We've seen a real shift away from the froth of the market. As we say, a lot of the money came flooding in, and that has dried up to a trickle. And I think, again, when you have the resilience of a structure where you have that permanent capital, that allows you to ride both, the better times in the market, but also to be resilient in the more difficult times. And for us to be appealing to a different investor audience is really compelling.
So it's interesting because as a managing partner of a VC fund that is publicly traded, the way you organize your structure is slightly different from a traditional GPLP structure as you described it previously. So how does it practically differ from a traditional fund organization?
Well, I'd say from a day-to-day perspective, if you were a FinTech founder, you wouldn't see any real difference. So we do the same level of due diligence. We will engage in the same way. We typically would take a board seat. The reporting requirements aren't any different than you would report to a traditional GPLP structure. So for the FinTech CEO or management team, they don't really see any fundamental difference. Of course, some like the idea of having that indirect exposure to the public market, a little bit higher profile at times, and that can be impactful as well. From our point of view, we have two key reporting periods. We have clearly our full year results, which are at the end of March, and then we have our interim results, which are at the end of September. We usually report those 2 months later. And we would report the aggregated net asset value of the fund. So in effect, what we're not doing is opining on every single asset, giving any level of detail in terms of their performance, other than the performance that a particular company is quite comfortable to disclose. So, yeah, I mean, I think the amount of reporting, the engagement with the investor community, the analyst community isn't overly onerous. I would say clearly quarterly reporting would add another dimension to that. But for the investment trust structure, biannual reporting is the typical approach, and that works well. So yes, for me, for 2-3 weeks every 6 months, I'm incredibly busy reporting our results. The team are preparing results. We work with our auditors, BDO, to prepare that detailed valuation. But again, from a day-to-day perspective, we wouldn't say it's fundamentally different to a typical GPLP structure, and actually doesn't put any added impact or request for work on portfolio companies either.
But the nature of the relationship you have with the LPs versus with retail investors is not the same. So how do you manage this?
Well, it's a good question, because it's a tricky piece of navigation, because we think a few thousand investors, but we don't really know, because if you're an investor in a retail platform, Interactive Investor being one of the biggest retail investment platforms here in the UK, we don't have the exact data from them to say 753 investors hold Augmentum on our platform. They show up on our cap table as Interactive Investor nominees. So, it is our job where we can to look to communicate with investors, whether it's directly through those retail investment platforms, and of course through the fund managers who are holding Augmentum on behalf of their clients. That is the more straightforward relationship. But of course, when you have a large number of retail investors, some of whom you're aware of and many of whom you aren't, it is really important to make sure you're getting the message out. In particular, in times of difficulty, and we've seen over the past few months,
days also,
that retail investors can get spooked. They can get spooked by market movements, and it's really important for us to articulate how that impacts our underlying portfolio, how we're protected, how they are protected, the approach that we're taking, our view on valuation. So I think really it is absolutely about being on the front foot. It is about communicating when you have something to say. It is not about communicating for the sake of putting PR releases out there, but we are very conscious of the importance of giving information flow to the investor community, and we look to do that. And we've just done that. This morning, we issued a note to the market as a result of the Silicon Valley Bank UK collapse, which thankfully has been rescued by HSBC this morning as well. But again, a lot of our investors were directly contacting us, wanting to understand the impact on the portfolio, the impact on Augmentum itself, which, as a matter of fact, wasn't material in any way. But I think they wanted that reassurance, and it was important for us to give them that.
There is an important point that you mentioned is also the fact that you don't have the same deadlines as traditional VC funds. So how do you approach liquidity events, meaning that when do you decide to exit investments? And because it's not the same, you don't have the same constraints as closed-end funds.
No, you don't. But at the same time, I think you have to look at liquidity options, as and when they arise. Clearly, the typical time period for Series A, Series B would be somewhere between 5 and 10 years. But ultimately, we have businesses we've held in our previous fund that we've rolled into this fund that are continuing to grow and grow well and have gone through some ups and downs. And thankfully, we held them where, in that particular case, one or two of the earlier VC investors have had to exit that at what I would regard a heavily discounted price. At the same time, we just announced an exit a few weeks ago, a business called Cushion, which was a workplace pension platform that was acquired by NatWest Group here in the UK for around £200 million. Now, we only held that investment for about 18 months. So it was an unexpected exit. We weren't actively seeking it, but at the end of the day, the offer came in, and the key investors around the table, and most importantly, management felt it was in the best interest of the business, and so they made that. They made the decision. Now, I would say in certain funds, having a high IRR return but not a high multiple of money would be an issue. For us, we just looked at it very objectively, and we said, this is a fantastic IRR. It's a decent multiple on money, but it's not spectacular. But we can go again, and we will look to reinvest that money as and when the right opportunity presents itself. So I think you have that added flexibility, and that is a really good example of one where we hadn't predicted, but we were able to be very supportive to the company and other shareholders who, frankly, were keen to take up that offer, whereas perhaps we might have been keener to be a little bit more patient and hold on for a few more years. But ultimately, it was in the best interest of all shareholders to accept that offer.
Okay. Last question I will ask with regard to the fact that you're listed is also looking back after all those years, what are for you the main challenges and opportunities that have come with managing a publicly traded fund?
Well, I would love to tell you it is all plain sailing and very straightforward. And I didn't have any grey hair before I started this. Actually, 5 years today we listed. I think, the challenges of being listed is you are beholden to market sentiment, to underlying economic environment. There can be events completely out of your control that can have a significant short-term impact on your share price. Of course, what we've seen over the last few days is a very good example. I think the benefit of being a closed-ended private GPLP is you take the money, you invest it, come back in 10 years, and we'll tell you how we did. And you're not subject to the same scrutiny and transparency. So, there are pros and cons. There is nowhere to hide. There are clearly factors outside of your control that can sometimes frustrate. But fundamentally, I think for me, you have to have belief in the long-term strategy and in the underlying strategy of your portfolio, in its strength. And I think if you do have that conviction, that ultimately over time, you hope you will deliver those positive outcomes and returns to shareholders, that you become a little bit less volatile in terms of kind of share price movement day to day. Because we all know venture is not an overnight success story. It takes time, and there are plenty of twists and turns along the way. So being in the public eye every day does have its challenges, but certainly the positives do outweigh the negatives.
Excellent. Okay, so now if we deep dive into what you do day to day, can you please describe your investment thesis and tell us why you decided to go for FinTech?
Yes, I mean, I think if you go back 10 plus years, it was pretty unusual for venture funds to be specialists. I think the view was that you needed to be generalist. It's a broad church. There are a lot of sectors to attack, and to be too niche was to be too limiting. And I think my lesson with the betting industry was that when I looked at the impact that technology had as and when the regulator started to embrace change, I could see back in 2010, post-financial crisis, in particular in the UK, that there was a real shift in approach from the regulator, that innovation needed to come. There needed to be a catalyst of change. And regulation, frankly, had been a big inhibitor of innovation, as we know, across a number of industries. And so that was really kind of the light bulb moment that we were going to embark on a decade or more of real change. And if you look at the size of the financial services sector, and it depends exactly how you clarify and classify, I should say, how big it is, but we're talking about a $14, $15 trillion global revenue opportunity. So it's an enormous, hugely complex, deep, and fragmented market. And I think to really do it justice, for me, there was a real desire to specialize and start to understand the sector in a lot more detail. And frankly, even though we are specialists, there are areas where I would argue, we still don't have the depth of expertise in order to opine. So even within financial services, we do tend to kind of focus on particular areas. And for us, although we can invest across the stages, Series A, B, C, because of the permanent capital structure, our focus, our bread and butter, where we feel we can have the greatest impact is at the Series A.
Okay.
I think the challenge for us at seed and pre-seed is that it is a noisier market. Clearly, the risk is higher. The time frame is longer. And I think being publicly listed and trying to build a brand, however patient and understanding our investors are, I'm not sure they would quite have the stomach for pre-seed and seed. And so we have tended to focus as our entry tech at the end B, because one, we have enough proof points in our view to feel that the business has got enough product market fit that we can reduce that risk, but also recognize that our capital experience and approach, and obviously some cross-pollination and learnings across the portfolio can really help turbocharge these businesses. And that's when I think we feel the most comfortable, and also where we can genuinely have the greatest impact as investors, as board members, and hopefully follow them on the journey for as long as it takes.
And in FinTech, there are many, many different now sub-verticals in payments. I've been discussing with Seema Amble also from Horowitz about the CFO stack, for instance. So what are currently the main trends that you follow and you invest in?
So I wouldn't want to pigeonhole one or two particular trends, because if you look within financial services, there are trends that become very much in vogue. I think the CFO stack is one where there's a lot of interest, and rightly so. But I think there are a lot of subsectors within financial services that have had a significant amount of capital over the past 10 years, but remain significantly underpenetrated by disruptors. So even if we look at payments, we are still looking at a sector that is sub 10% penetrated by innovators. So pretty much every subsector within financial services is single digits in terms of disruptor penetration. So I think we're really excited about the space over the next decade, that there are going to be hundreds of very valuable businesses being built. But of course, we all have our focus areas. We are all evolving our thesis depending on kind of how the market is moving. For us as a team, the infrastructure layer remains very interesting. Clearly, there is a lot of innovation still in payments going on, but it is a heavily competed and fragmented space. So the question is, you've really got to find that differentiation. Personally, I'm particularly focused on the asset and wealth management sector and the digital banking sector. If you look at the size of the asset and wealth management space, and you look at the amount of capital that has been deployed in innovative solutions, it's actually pretty surprising as to how little penetration there has been so far. But I do think we will see a significant sea change over the next 5 years, where a lot of that base investment will start to come through. And I really do think you will see more breakthrough cases. Another area of interest, and again, France, Germany, and the UK have very strong insurance sectors. Insurtech, I would say, has been a bit of a disappointment, if I'm totally honest, over the past decade, relative to the dollars, euros, pounds invested in terms of returns. I don't think there has been a single unicorn exit in Europe in Insurtech. There have been a handful of unicorn valuations, but ultimately the proof is really at exit. So I think that is a really interesting space where we recognize the huge inefficiencies, the lack of digitization, the lack of innovation. But at the same time, it has been a hard nut to crack. But I do think we will see much more progress over the next 2 to 3 years in that space. And we have looked very closely at the Insurtech space generally over the past decade. We've just made our first investment. We must have looked at well over 100 in a lot of detail. We've backed a business in Germany focusing on cyber insurance, which is an area of real a real challenge, a real concern for both small businesses and enterprises alike. But again, a long way to go in seeing that industry evolve. So hopefully a few examples there of sectors where, we do expect to see a bit more penetration. But as I said, I think you will see a lot more innovation over the next decade. And although fintech is a well-used word, I think what people often miss is quite how early we still are in the journey. And yes, there has been a lot of capital in our sector. Yes, at times it has overheated in part, but fundamentally, the bulk of the innovation is still very much ahead of us. Yeah. And, I think that's what, investors and entrepreneurs and future founders are particularly excited about.
How are you organized internally? Do you have operating partners and people supporting? Because you know that, fintech is very complicated also from a regulatory perspective. Is it something that you also bring to the entrepreneurs?
We're a small team. Venture capital tends to be small. We don't have a huge cost base. I think one of the things I didn't talk about in terms of the listed structure is the fee flow. It isn't quite as lucrative as the 2 and 20 model that most venture funds have. So as such, we have to be focused on our costs. So the investment team is 8, and we have a support team of 5 on top of that, so a total team of 13. And I think we have to kind of manage our time accordingly. So we want to be involved in our businesses. So we would have, I would say, 4 more senior members who tend to take the board seats, where they have really extensive experience over the past 20 years, in working with high growth businesses. And then our, senior associates and analysts as well, working very closely alongside the operating partners in, helping kind of navigate that journey as well. And they do work kind of hand in hand with the, more senior members of the team as well. So I think it's a pretty efficient structure. Often when we meet our investors, we do our annual capital markets day, and, they come to the office and they see the team. They're like, wow, I thought you would have had 3 or 4 times the number of people. I'm like, not on that budget. So we have to be smart with our time. We have to recognize where we can impact and not kind of overpromise and underdeliver. I think, the motto is always underpromise and overdeliver. And hopefully we've largely done that in the last few years.
Okay, excellent. So we don't have a lot of time left. I wanted to stop a little bit on a few portfolio companies, because you have great portfolio companies such as Money, Tide, Onfido, and Volt. Do you want to take maybe 1 or 2 and explain to us why you decided to support them?
Sure, I can. Maybe I'll give you an example of Tide, because I think there's an interesting comparator in France, in particular in Conto, and similar to the challenges of small businesses in France. Over the last decade, it's been increasingly difficult for UK entrepreneurs, founders, small business to open bank accounts. And we were first introduced to Tide back in 2018. We recognized how difficult it was, even for us as a fund, a newly listed fund that just had £90 million put in a bank account. When we spoke to our UK bank about creating a new account as a result of our listed structure, they told us it would be 6 months in order to open that account. And I think that really opened our eyes to say, hang on a second, we're a publicly listed business. We've been banking with you in our previous fund for 5 years, and you're telling us it's going to be 6 months to open an account.
Wow.
So the first port of call was to look in the market to see who was really doing something innovative for small businesses, and we invested in Tide in 2019, and we've really seen them grow from an emerging, champion of small business with a few hundred small business accounts to nearly 500,000 small business accounts, and I think now would account for about 8 to 9% market share.
Wow.
Of the UK SME banking sector. So I think, a great example of a business that was really trying to solve a major headache for small businesses, to offer them a digital platform that was straightforward, easy to use, transparent, and low cost. And 3, had the ability to continue to scale along the way. And of course, the ambition doesn't stop here at 8-9% market share. But ultimately, there have been a number of players who've looked to crack the SME banking space across Europe. And I think really, I would say, 2 or 3 are really starting to break through now. And obviously, Conto in France have, done that very well and are looking to expand, pretty extensively across Europe. So I think for us, Tide is a great example of the type of business we like. One, a business that is really solving a significant problem in the market. 2, that has huge ambition, but 3 is at a stage where they're really looking for that input, not just with capital, but in terms of support from a fund that has been part of multiple scale-up journeys, over the past couple of decades. And hopefully we have kind of, in a small way brought some of our expertise and experience as well as our capital to the table. And that's been a great story to be part of. And hopefully, still a long way to go with that business in terms of its ambition.
Great. So what are your next steps? Crypto?
Well, I think, crypto
you didn't say a word about crypto.
Yeah, crypto and digital assets has been a hot space. I think for us, our focus in that area has been in the infrastructure layer, focused on those that are looking to build solutions for the institutional layer. I think we aren't particularly interested in any way in the speculative trading of assets, but ultimately we do think there is a long future for a well-regulated, well-defined digital assets industry in a number of different dimensions. So I think for us, we've dipped a toe in the water when we haven't jumped in with both feet. I think we continue to watch quite closely. I think the fallout in the past few months has been unsurprising, but I think in any emerging industry that grows as quickly as something like crypto, there are always fallouts. And I think it's a healthy outcome. Of course, it's not healthy for those that have been left out of pocket, but fundamentally, I do think we will see those longer term players who are really building the businesses in the right way start to come through. So I think there is a good future, but it's not a future that is going to be determined over the next 12 to 18 months rather than over the next 5 to 10 years.
Okay. So your next steps, what are they?
Next steps in crypto generally, or
no, in general. In
general. Well, look, I think for us, today we sit as a £300 million net asset value fund. We want to continue to grow. We want to continue to be one of the key fintech investors across Europe. We want to continue to expand our footprint beyond the UK, which we've done in particular in the last 18 months. And we just want to support and back some fantastic fintech companies across Europe. So I think it's important for us to continue to demonstrate success, and that is in results and delivering a track record. And I think if we can do that and navigate the ups and downs of a challenging economic environment, then I hope that, we can continue to be one of the mainstays of the European fintech community.
Thank you, Timm. I always ask a recommendation of a book. So if you have something in mind that you would like to share with the audience.
I've got a lot on my list at the moment, but I must say the one book I just shared with a founder is the book by Phil Knight about the Nike story called Shoe Dog. For any aspiring entrepreneur, existing entrepreneur, emerging entrepreneur, it's an incredible story of resilience, perseverance. And for those that know Nike, it's certainly not a story I was aware of once you get under the hood. And it's a pretty inspiring journey. And I think actually now they might even be making a film about it. So read the book before the film ruins it for you.
Thank you very much, Timm. Thank you for all those details. That was really, really insightful.
Thank you. Lovely to be here. Nice to chat.
Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.